welcome to our Credo and Winthrop Market Outlook call for the ending of the first quarter. And we have Freddie and Adam. Wanted to ask you guys, could you just give us a recap of last quarter and what's driving markets today?
Yeah, I think both Freddie and I can speak into this a little bit. I'll start at a high level and then turn over to Freddie. But unless you've lived under a rock, this last quarter was extremely volatile. And that was obviously primarily driven by this narrative, as the word I'm going to use, around tariffs, implementing tariffs fairly globally, and then just the retribution for that kind of got markets scared for two things. One was that we might enter this kind of phase where the stagflation is the word that was thrown around a lot, which basically means economic growth might slow because just the overall sentiment was negative, and just the impacts of higher input costs could push pressure on the economy. But at the same time, the worry was that tariffs might be inflationary. So that would be this pretty terrible dynamic. Growth is decelerating, but prices for goods are going up, which would put even more strain. And to further that would make the job of the Federal Reserve near impossible, because their mechanisms kind of work in the same direction. So the things that would help stimulate growth would create more inflation. So how you would combat that would be extremely difficult. And so that just had markets really worried about what was kind of unknowns with policy out of DC, and then obviously the unknowns around what the Federal Reserve could and could not do to solve that. Freddie, I don't know what you'd add to that.
Yeah, those are definitely the two main drivers right now. So I think you covered it.
Okay, well, so my second question, you probably answered a lot of this, but how are tariffs impacting corporate earnings and capital markets? And how are tariffs impacting consumer prices?
Yeah, so we haven't really seen a big negative impact on corporate earnings. We're just about finished with the Q1 season right now, and almost 80% of S&P 500 companies are reporting a positive earnings surprise. The year-over-year earnings growth is 13.4%, which is higher than expected. The one thing is a number of companies have withdrawn guidance entirely, but that's just simply out of uncertainty, just waiting to see how things play out. But in general, corporate earnings have held up quite well. In terms of capital markets, as we've seen over the last week or two, they're actually showing some resiliency here, with the S&P making back the majority of the almost 20% decline that we saw last month. And as for consumer prices, we'd say that it's still unfolding. We haven't seen the full effects yet. The headline inflation number that we saw this morning came in below expectations. So CPI year over year was 2.3%. We believe this could be temporary. There's a potential that this is going to rise over the next few months, just given negotiations and where tariffs are headed.
Okay, let's see here. And what sectors of the market are the most impacted by the administration's tariffs? And have you changed your sector weights in the portfolio this year?
Yeah, so there's an impact on a number of the S&P sectors and subsectors. To name a couple key ones, autos and auto components, machinery, industrials, retail, and apparel will probably be the key one. With higher input costs and disrupted supply chains, we're going to see a lot of these industries affected. In our portfolios specifically, we've remained underweight consumer discretionary, where we've seen a notable impact. Many products rely on imported components, and these costs are ultimately passed on to consumers. And we've seen the cutback on discretionary spending in economic uncertainty. And then you also have a consumer confidence, which hasn't bounced back just yet. So this sector still remains the worst performing sector in the S&P. And then on the other hand, again, defensive sectors like utilities and healthcare are less exposed to international trade, and we see them potentially outperforming in an environment of volatility if that returns due to tariffs.
Okay. So let's see. After the S&P 500 had very strong years in 2023 and 2024, it was down, obviously, in the first quarter, 2025. What are the key drivers, and what are your expectations for the S&P going forward for the rest of the year?
Yeah, so I'll go first, and Adam, if you have a differing opinion, you can follow up. But markets have reacted quite favorably to the trade deal that was just announced between U.S. and China. It obviously reduces the tariff rate, but it still imposes, I'd say, significant costs on U.S. businesses and consumers because the effective tariff rate is still high, which ultimately could lead to slower growth, higher inflation, rising unemployment, the stagflation that Adam was mentioning. And even through more trade deals that we might see in the future, the effective tariff rate is likely to stay above 10%, which the administration has, I guess, quoted as the floor. And so even since, I guess, Liberation Day on April 2nd, the S&P is actually 2% above where it was. So this is prior to the tariff announcement. And the question really is now, are we better off today than we were before? So I personally think it would be very surprising for the index to reach all-time highs this year. We expect GDP to still be impacted by at least 50 bips and the rate of inflation to increase eventually. The odds of a recession are fairly low, and we don't see a bear market, but I do think we're a little stretched right now, and the upside is a little bit more limited.
Okay, that makes sense. And what trends are you seeing in the labor market?
Well, and we continue to see labor market soften incrementally, but by no means is it something to cause alarms. I think we thought it was going to probably be softer than it is. So I would put it as just like the consumer has stayed fairly resilient, given off such a, we came off a fairly low base of unemployment. So, to be in the mid 4% unemployment range, I would say is fairly normal and potentially healthy, I guess, for, an economy that there's obviously going to be some slack from, connecting jobs. So right now, it doesn't give us any reason to be alarmed or think that there's a, recession looming right now. What I would say is, and until it softens further, it makes it more difficult to make a case for the Fed to lower interest rates. So I think that may be one of the kind of side effects of a stronger labor force.
Okay. And how do you see capital markets adapting this year, and how has this impacted your portfolio positioning?
Yeah. So first off, you're going to see continued heightened volatility. It's probably not going to be, we're not going to see these massive spikes in the VIX towards 50 or 60, but we'll probably have kind of this steady volatility that's above that normal 15% or so, probably stay closer to the 2025. Because as Freddie was kind of hitting on earlier, it's unlikely that this whole thing is done. So there are probably going to be just erratic things that come out of policies over the next several months, and we'll have to digest that. Markets will digest that. But right now, markets are very fickle around the next data point, the next headline coming out of Washington. So that's a time to stay more defensive. And so in getting into what our asset allocation looks like going forward, I do want to rewind to kind of how we came into this year, because it's important to think in those terms, is that we did have a fairly defensive tilt. Now, we were, I would say, fully allocated from an equity standpoint, so if you were a traditional 60-40, we had all 60 invested, but that 60% per se in equity had a more defensive tilt. And that's worked so far this year, where you've seen, like the minimum vol ETF is outperforming the S&P by around 500 basis points in my last look. So taking those pieces that have worked, where the defense has worked, and finding different opportunities. Some things we were doing when we were further down, when the S&P was further down, we were actually taking some of that minimum vol off and just adding it to the neutral basis, the S&P 500, for example. So not taking an outside bet outside of the S&P, but since we came in more defensive, kind of shifting more towards neutral. And so that's probably what I would say is that over the course of this year, as we become more comfortable with things, is using that outperformance to move just to a neutral stance so that we can then remeasure and say, okay, where do we want to take our bets for the next 6 months?
Got it. Great. Well, thank you so much for the update. Really appreciate it. And fingers crossed for the rest of the year. Take care, guys.